Hello and welcome to Wisdom Bites. Hope you're well. Thank you once again for joining us. Very much appreciated. And in today's packed program, I'm going to be having a look at what's happened to the Bitcoin price, which looks like there is a change of momentum, sentiment, and outlook, not only for Bitcoin, but also for the wider markets as well. The main thing is always to look at the bigger picture and see exactly how the current short-term price movements are fitting into the bigger picture view in order to get a balanced view going forward. So I'll be having a look at exactly what's in the news, what's causing the price of the Bitcoin to have a sharp downturn, and we'll have a look at the outlook for the wider markets as well as Bitcoin going forward over the coming weeks and months. So if that sounds interesting, then without further ado, get yourself a cup of tea, sit yourself down, eyes on the screen, and let's get cracking. But before I begin, the usual polite reminder, please remember everything in my videos is just for educational purposes, so please always do your wider research before you make any investment decisions or any swing trade decisions. And we really have to begin with what's happened over the last few days with the Bitcoin price, as well as the wider markets. And just last night, what we've had is the Bitcoin price crashing below the 53 key level here. And the question really is, what has caused the price of the wider markets as well as Bitcoin to have such a free fall over the last few days? When we scroll down here, we'll get to the bottom of it, and that is that the recent turmoil has been really the weak jobs data, which didn't seem to be penciled in by the Fed meeting that we had last Wednesday. So up to last Wednesday, it looked like we were going to have a soft landing in the USA economy. And what we really had was that the US job growth had slowed to 114,000 in July, while the unemployment unexpectedly jumped, much higher than expected. So as the Fed have left the interest rates unchanged, if they had had this data, they certainly would have reduced the interest rates by at least 25 basis points. And why would I say that? The evidence is here in terms of the expectation for the target interest rates for September. And as soon as the jobs data came out, this figure has now jumped to 98.5%. And this is penciling in a 50 basis points reduction in the interest rates coming up in September. So this is the expectation. The current rate is 5.25 to 5.5, and the expectation now is a 50 basis cut in September, and we may well get an emergency cut before then. So had we had that data, this would surely have brought the interest rates to be cut by at least 25 basis points to mitigate the weak jobs data. So the question now is, what does it really do in terms of expectations? And a lot of people look at the SAM rule, which really has now been triggered in terms of the possibility of a recession. So this rule is a recession indicator, and this has now been triggered, meaning that the majority of people are now expecting a big recession in the US economy, which is a big deal because that's the driving force for the whole of the world economy. So as the saying goes, when the US economy sneezes, the whole world ends up with a cold. But there's a lot more to this than meets the eye. As we look down here, you'll see that it's not really a hard and fast rule, because what we see with this SAM rule, because the data that is actually used to make recession calls suggests the economy is still expanding. And this recession indicator was actually triggered by the July jobs report. However, when you look down here, you'll see that the person who actually created it doesn't think the US economy actually is in a recession right now. Whilst at the same time, the Federal Reserve Chair, Mr. Jerome Powell, said the indicator doesn't actually carry any particular significance. So despite all this, what we've really got is a wide sell-off in the market. So what we're going to have a look at is what's happened in the wider markets and with Bitcoin in the short term, and then to zoom out and see what is likely to happen over the coming weeks and months. The first thing I want to have a look at is the liquidation heat map and show quite clearly what's happened is that all the stops for the leverage players have now been taken out with this big fall that we've had over the last few days. So you can see there's hardly any leverage stops here. And the only stops now looking up here are the ones at around about the 61, 62,000. So what this would suggest is that the price for Bitcoin has more reason to go up rather than to go down from a liquidations point of view. The other thing to note, which is becoming increasingly important, is the grayscale bleeding that has been going on for the last 6-7 months. And instead of actually subsiding, which at one point it was over the last few weeks, it is now accelerating one more time when I show you the other figures on the ETF inflows and outflows. So what we've got now with the Grayscale is come down from 619,000 to around about the 240,000 level. So that's just under 400,000 Bitcoins have been bleeding away from the Grayscale Trust. And obviously most of them have been picked up here by the other ETFs, but it does look with a high probability that this figure is going to carry on going until it gets to as close to zero as possible. So we need to just expect that this is going to be a continuation over the coming weeks and months. So this will act as some sort of a bearish pressure on the Bitcoin price. And as you can see clearly with this asset inflows and outflows, the Grayscale Trust over the last 7 days, so since the last time I did this video for you last Monday, the Grayscale Trust has lost over 30,000 Bitcoins. And some of it has been picked up by the BlackRock ETF, but also the other ETFs have also now been bleeding down. And people may not be aware, but Grayscale created this mini trust of theirs because of the bleeding that they were having in their main trust here. Because of the higher fees, they've now decided to create this mini trust with much more competitive fees. So their own Bitcoin mini trust has picked up about 3,000 of that. But as you can see with the others, there's quite a lot of red figures here. So there's been quite a lot of bleeding, which may explain partly the fall in the Bitcoin price apart from the jobs data. And if we look at the wider markets, we'll see that the structure of the markets is now beginning to fracture. So what we've got with the SPX here is that if you look at this through the eyes of the 60-day cycle, as expected, towards the end of the cycle, we're getting a 60-day cycle low. And for all intents and purposes, this was the end of the previous cycle and the beginning of the new one on day 66. And then going above this previous high here on this candle was really confirmation that this was the start of the new cycle. But what we've got over the last week is a fall below the actual low of the cycle here, which means we've already got a failed cycle on our hands. So what we've really found here is that the Federal Reserve has found itself outmaneuvered by the unemployment figures, and the concept of a soft landing is being thrown out of the window. So the Fed has really found itself behind the curve, and what we've now got is a big sell-off in the SPX, as well as the wider market. This could obviously be a trap, and the equities can recover, but this looks quite unlikely, because when you have structural breakdown like this, it does take time for it to recover. So the expectation over the last few weeks was that we're coming into the 60-day cycle here, and we made a 66-day cycle low and the start of a new cycle. So this was working exactly fine as you would expect in terms of the 60-day cycle time frame, but the developments over the last week has now meant a failed cycle here. So what we've really got currently at the moment to explain this price is that we're coming up to this resistant point here as a support at this level. But the sentiment and the outlook and the momentum has certainly shifted now to the downside. So we would expect with a higher probability for us to retest this level here at around 5,250. And that may well be where we get a counter trend rally, and looking at what happens further on will determine whether we're going to get a big recovery or another leg down to much lower levels. So we really just need to keep an open, fluid and flexible approach to the whole thing and read it without emotion, because when you look at the larger picture time frame, it looks much better than what the short term would suggest. On the gold front, what we've got really is still higher highs, and also we've got the higher lows here. So the trend is still going to the upside. So gold is still acting as a hedge against the markets. And of course, if there's a much bigger sell-off, it will get caught out with that. So as we would expect with gold, it's acting more of a hedge in the short term at least anyway. But if we have a look at the picture for silver, it's having a completely different effect. So while we were creating this consolidation with a view for a continuation pattern to the upside, unfortunately, just like the SPX, what we've really got is some sort of a sell-off taking place here. And we are creating lower lows here and lower highs at this moment. So it may well be much further to go down at the moment. So a different picture emerging with silver in relation to gold. And if we move on to the dollar, what we can see here is the continuing emergence of a fall in the dollar as well. And with the prospects of the interest rates falling, what we can expect is for the dollar to be continuing to fall to the downside. So it's this prospect of falling interest rates now as being incredibly highly likely now that we're seeing the dollar price falling. And that should really allow for the markets to recover recover in the coming weeks and months. And if we move on to the 60-day cycle for Bitcoin, just like the SPX, what we've got is that the start of the cycle here on day 65, we were going into this midpoint on a bullish trend up here, all the way up to 70,000. We would normally expect with a mid-cycle pullback, it would normally have come back to these levels here at the top of these wicks. So this is where you would have seen a big bounce back to create a right translated cycle somewhere here. And that would have given us more wriggle room to run into the 60-day cycle, either to retest the 74 or even break to the upside. But as I mentioned in the last week's video, to go from 53,000 down here to breaking above 74,000 seemed to be too much to ask for Bitcoin to do in one cycle. So the expectation was always that it's going to be in the next cycle here. As long as we can consolidate around here at the end of the current cycle in September, then that would have been a good basis for a big move to the upside, breaking the 74,000. But this big fall here would suggest that it's now going to take much more longer time to recover. And up to the 53,000, you would normally expect this to be the normal ebb and flow of the markets, as it's been here. These are just the normal ebb and flow of the markets, highs and lows, in a consolidation pattern, which would, for all intents and purposes, be a continuation pattern to break up to the upside. And I can only share with you my own thoughts when I see these big falls down here like this. And one of the first things that really always comes to my mind when there's a big sell-off like this here, as there was down here when it came down to the 53,000, when you get these types of sell-offs, my own thought to myself is that don't become a victim of Bitcoin's emotional roller coaster. And what that means is that Bitcoin can really hurt you if you're constantly responding at the end of these oscillations. So if you're responding to this big move here by buying here and responding to this fall by selling here, then the Bitcoin price and the crypto space will always hurt you, because what you're really doing is getting in at the top and getting out at the bottom. And you really need to reverse that psychology and the mindset. And for me anyway, well, we've got to mitigate the downside risk. So the question is, how do you play all this, i.e. this fall in the market? And you've really got to look at the key levels as far as I can see. And the key level here is the 53,000. So this candle here, so the low of this was at 53,500. And while we've breached this, you really need to wait for a candle close below this figure here, 53,500, before you know that there may well be a wider sell-off going much lower with the Bitcoin price. And I always want to bring everybody back to the bigger overall view here. If you look back in history, you can see there have been very wild pullbacks with Bitcoin in the past. I remember from 2019 when the price reached 14,000, we came back down here by 71%, even though we were in a bull market trend at this point. So the COVID situation pulled it back all the way down by 71%. And then look what happened afterwards. This is where we got the start of the big bull run towards 2021. And when you look at this here, the current pullback isn't really wild compared to what's happened in the past. And the main thing to always remember with this particular chart is telling us that we are on a journey from where we were at the end of 2022, where we bottomed out at the end of the bear market, and we are part way through that journey, and for all intents and purposes we still have a long way to go towards the end of the bull market, unless there are very serious indicators telling us that we may well be back into a 12-month downturn. Until you get those types of signs, and I'll show you one of them which we have to keep an eye on, but until we get those, we have to assume that we are in a bull market and we're going to get these short-term oscillations, however wild they might be. And with the Olympics going on, if I use an analogy, the prizes are not given halfway during a race. It's usually given when the race is finished. And we're expecting that finish to be anywhere around here from mid-25 to the end of 2025. So we still have 12 to 18 months for this Bitcoin race to be run. And in between, obviously, there are going to be these oscillations, which you have to manage from an emotional point of view. So as painful as it may sound, but your portfolios along the way are going to show ups and downs until we get to the end here. And those who can manage it the best will probably make it to the top of the summit here. So in order to look at the bigger picture view, we have to zoom out on the monthly time frame here. So what we've got here is a cup and handle pattern, which is now producing this larger handle over here. And according to the classical charts, this would break up to the upside. But obviously that doesn't mean that you don't mitigate your risk to the downside here. And the main thing for me anyway here on the monthly time frame is the 8 exponential moving average, this blue line here. If we close below this blue line on this monthly time frame candle here, then that would be quite concerning, because you would not expect at this stage of the bull market to be closing below this 8 EMA. Because when you look back in history with Bitcoin, this is the top of the bull market. And as you can see, all the way along here, all during the bull market run, there is no candle that's actually closed below the 8 EMA. So similarly for the second cycle, you can see quite clearly, once you get out of the bear market, the price doesn't close below the 8 EMA until you get right to the top. And this was the anomaly in the previous cycle, where the first top, which was the technical top, we did actually close below it. But once again, after the 69,000, once we closed below it with this candle, this was the signal for the bear market here. So this is what I would suspect, that if we closed a monthly candle below the 8 EMA, that for me would trigger a defensive posture by taking out maybe 50% or even 75% of my holdings in order to mitigate the downside risk here. So for me, that's the way I would be playing this. And everybody's got to make up their own mind. Obviously, this is not financial advice. It's always better to do your wider research and come to your own conclusions so you can feel happy with the decisions that you've made. But the way I see it is that if you look back at this consolidation, this was the low point here. And at this stage of bull market, you would not really be looking to break below this, i.e. a daily candle close below this level, which on this chart says 53,499. As long as we don't get a close below this 53,499, I can see a bounce, at least a counter trend rally back to this trend line here. So when you go back at this point, you can see there are support lines here, which we've just broken through. If we can maintain this 53,499, we should get some sort of a counter trend rally back to this support to act as resistance. But then we have to wait whether we can recapture this or not. Recapturing this would be an incredibly bullish sign, but obviously being rejected at this point would mean that this point is more likely to be then broken down. And then we're looking at this red line here. When we zoom out, we see where this support line is. This all the way back to this 15,400 back here. And we've had a lot of support on this line. So you would expect with a higher probability for the price to bounce back from at least this level here. And breaking this would really be quite critical, because then you're breaking the structure of the chart. So let's see where it goes. That's how I see it. 53,499. A daily close below that would mean that I would have to take a defensive posture with my Bitcoin mining positions by taking out maybe 25 or 50% off the table. And if we break this here, then that would really mean that I would have to be out of my positions until there is a reversal anywhere down here. I don't see this breaking, to be honest with you, at this moment. But as with Bitcoin, we know that anything is possible. And we just always have to remain open, fluid and flexible, and never let your own narrative dictate your actions. And for me anyway, I remain open, fluid and flexible and let the Bitcoin price dictate my actions based on these charts with the support and resistance levels. And that for me allows me to manage my positions much more better than allowing my emotions to dictate my decisions. So I'm going to leave it there. Hope you found value in the video, and if you did, then please do remember to like and subscribe if you haven't already done so. And if you've got any comments, leave them in the comments below. Until the next time, take care, stay safe, and I'll see you in the next video. Bye for now.